What's going on, you guys? It's 2024, and we still have a lot of traders that are still not profitable. And the reason being is because they don't understand true market structure. In this particular video, I'm going to give you guys 5 steps to establish your foundation, understanding what's the expectation from reality, how to identify valid and non-valid swing pullbacks, the importance of premium and discounted pricing and how it relates to the market, understanding the importance of a fractal market and how we can break it down. And then last but not least, we're going to put it all together to give you guys a market structure entry strategy. Hey, you guys, I appreciate you guys joining us. Click that like and subscribe button so you guys can be notified when we drop videos like this. And let's go ahead and get into the video.
We strategize, then we capitalize on what we see. Wanna go to Pittville? Come join the Pip Academy and learn the Pip drill. Let's take the trip to Pittville.
All right, you guys, so let's start off with understanding just basic market structure, and let's look at the expectation versus the reality. So the expectation is for market structure to look clean cut like so in this particular model. When you look up textbooks, when you look online and you want to just look up market structure, this is a model that you will see. Okay, this is considered to be a bullish model because the trend is going up. And so if the trend was going down, it'll be considered as bearish. Okay, so to establish your foundation, what we want to do is we want to identify our low and we want to identify our high. Okay, and from this low here, this is considered to be our swing low. This is considered to be our swing high. Now, between this low and this high, this is considered to be our range. Okay, this is considered to be our range. Now, anything inside of this gray box that I just drew is considered as internal range or internal structure. Okay, so whenever price breaks out of this box, this is considered as a continuation in structure because it's continuing the trend. Okay, so now once we start to see a pullback, that establishes our next point, our next swing low, which is considered to be a higher low because this low is higher than this low. And this high is considered to be a higher high because it's higher than this high. So you will read this as higher high, higher low, higher high. I'm sorry, high, higher low, higher high. Okay, and then so on and so forth. So once we kind of establish our next swing points, that's where we can actually move this box up to pretty much put it within that particular range. And I know some people that are already experienced will ask themselves, well, why would I use a box? And I'm going to explain that in a little bit, and it'll help with simply a visual aid to understand where you are within the market. Okay, now let's say that price decided to go in this direction to break this low, and it wanted to do something like this. Okay, so now So now we've changed our characteristics and we've changed the direction of the trend. And so when it breaks this area here, this is considered as a BOS, which is a break of structure. Okay, so continuing in our current trend is a continuation in structure. If we break the trend, it's considered as a break of structure. Okay, so now we have a new swing high and a new swing low. Okay, because now like we said, our trend has changed characteristics and it's going in a different direction. So now we can utilize this box here to establish and say this is our current range. Anything that happens in this area is, like I said, our internal range or considered as internal structure. Until we break this box, anything that happens in this particular area is just a part of this internal range, this structure leg or internal structure. Okay, so now this is the expectation. When we see a bullish model or a bearish model, you know, we see these simple clean cut moves and things like that. That's the expectation that when price goes up, it'll automatically come down and so on and so forth. Now, when we get on the charts, The reality of the fact is that we might see something such as this. We might see all type of moves like this, and you may ask yourself, okay, this is a bit confusing. It doesn't necessarily look like, the textbook model. However, you can apply this foundation and these principles to the model such as this, because one of the things we want to do, we want to establish our low and our initial high. Okay. And so like we said, this is considered to be our swing low and our swing high. And what we can do is utilize that same box from the low to the high, and we can move that over. And we can say anything that's inside of this box is considered as our range, internal range, or internal structure. Okay. And this is why this box is a good visual aid, because a lot of traders will get tripped up by looking at the internal range or the internal structure. Now, one thing that I want you guys to understand is you have external structure, which is the big picture. And then you also have internal structure, which are these small peaks and valleys inside. Okay, so we have to establish what's internal and what's external. So when we break out of this box, we have to understand and locate our swing low for our next swing point, okay, or our next range. And so how you identify that is the lowest point inside of our internal range that established our swing high. So we'll be looking at this point here. And then when it broke out of the box, once we start to see a pullback, this is our next swing point, okay? So now we can say, okay, I can move this up to this area here. And I can move this to this area right here. And we can move and transition our box here. That way we have a clear picture of what our internal structure is, okay? So I hope that makes sense. A lot of this information or this internal structure can confuse traders, because what traders will do, let's move this back over to this area here. Sometimes what traders will confuse themselves with and how they get tripped up, they'll say, okay, I see that price kind of broke out of this area, and in this area we had a break of structure. Okay, so now I'm gonna wait for a pullback somewhere in this area, and I'm gonna try to short the market, something like this, and short it all the way down, to this area here. However, the internal structure is just pulling back in order to give our external structure the swing low to go higher. Okay, so we have to understand that it's the last low or the lowest low that led to the high. Okay, so let's just say, just like in our expectation model, let's say price decided to do something such as this. Okay, now as you guys can see, this was our last, well, we want to move our model because our model changed when we did this example here. So we had a swing low here and we had a swing high here, which changes. However, we can see that the characteristics of this model change. This now is a break of structure. Okay. And because we have this break of structure, now we have a new swing high and a new swing low. Okay. And because we have new swing points, we can establish this area here as our range. So anything that happens in this box is considered as internal structure until the box either breaks down or the box either breaks up. Okay, and I hope that makes sense, and I hope you guys can understand how the expectation can differ a bit from the reality. However, the overall principles are still the same. Okay, so now that we understand the basic foundation of what market structure is and what it looks like from your expectations to reality, we must then understand what is a valid and non-valid swing point, because this is one of the most important things when it comes to market structure, because if you can establish what's a valid swing pullback, then you can literally get tripped up in the market with this particular concept. So if we're looking at a series of candle structures here, let's just say this here is our low. Okay, this is our established swing low at this point here. Okay, as we can see, price decided to come up in this area here, and it decided to pull back slightly. Now, a valid swing pullback is 2 or 3 candles. However, it must pull outside of the previous candle's range. So if we can see in this area that this candle's range is here. Okay, let's just look at this blue candle. This is the range of this candle. You have 2 candles, however, they never pulled outside the range of this candle here. So this is not a valid swing pullback. However, if we can see that price just gave us a complex pullback here and it decided to break this high here, now we can look at this and say, this is our current high in this point here, because we have 2 candles that pulled outside the range of this candle. And when I say outside of that range, I mean there must be a body closure outside the range of this candle. So if we look at the range of this candle, we have a body closure that closed outside the range of this candle. And so body closures are really, really important. So for example, we can see now we have, this was our initial range here. Let me go ahead and change this box to a light gray color. Let's just say I'll pick something like this. Okay, let me erase that. So this is our initial range. Everything inside of here was internal structure. We can see that price gave us a pullback, and we can see that price gave us an impulse to another high. Now let's see if this candle pulled outside of this range as far as a body closure. Now we have a body closure, okay? So let's not get confused. When we're doing a swing pullback, it must be 2 candles outside of that candle's range. Now we're getting a swing to the upside. We have 2 candles that pulled outside of this range. So now this is our swing low. And when we look at this, this is our new range. I'm sorry. We can take this and put it here and here. Okay. So now this is our new range. Anything that happens inside of here is considered as internal structure. So we literally can get price to continue up and come down and things like that. Okay. But we haven't really established our swing high yet until we establish another low. So I just want you guys to really, really get this. So what validates a swing pullback, you must have 2 or more candles that break outside the candle's range. And when we're breaking above or below, it must break outside of the wick. We must have a candle body closure. So now let's look at the live market and see what we can establish valid and non-valid swing pullbacks. That way we can understand the market and see the actual ebb and flow of how the market moves versus the expectation and as to in reality. So when we're looking at this, we can see that we're currently in a downtrend. So the expectation is for the market to move in a wave such as this, where we have a high, lower low, lower high, and so on and so forth. Okay. So if we look at that, we can establish our high in this area here. Okay. And so as we're going down, we see we have a low, but our rules suggest it has to at least be a 2 candle pullback that pulls outside of the range of that candle. So we have 1 candle that pulled outside of the range. However, this candle is engulfed in the range of this particular candle here. Okay, so this is not valid. So we will move along to this area here. So this is our low. Okay, so when we look at that, this is our initial range in this area here. So anything that happens in this area is considered as internal structure. Okay. Now, if we're looking at this, we can see we have 1, 2, 3, 4, 5, 6, 7, 8. A lot of candles that pulled outside of this range, which gives us a valid swing high. However, it's not established until we get a break below this area here. So now we have a body closure here, and we have more than a 2 candle pullback. So this establishes our next range. Okay. So now we can take our box and we can move it down to this area here. Okay, I hope you guys can see how this works. We can move our box over. That way, now you guys can see visually how this particular box can give us a visual aid as to what the actual market structure is. Because like I said, a lot of traders get mixed up by that. Establishing their swing high and their swing low. Okay, a lot of traders get mixed up with this, and it can be extremely confusing at times. So as you guys can see, we had a low, we had price to give us a 1, 2, 3, 4, 5 candle pullback. Okay, pulled outside that candle's range, it closed outside, and then we got an impulse down 1, 2, 3, 4 candles that kind of broke below. Okay, so now here's our next swing low and our swing high in this area here. See how we can just literally just move our box on down. Okay, this area here. Now here's something where I want you guys to see. Okay, let's go ahead and realign our box in this area here. Now as you look at this area here, you can see that we have a candle that kind of closed here and it shot all the way up, and a candle here. However, you notice these 2 candles, we never got a body closure. Okay, we never got a body closure, which signifies that these are what are called liquidity grabs. These are not structural points. Okay, this is our structure here. From here, we can see that price impulsed it to another high, which establishes our high, and then price came all the way down and established another low. So here's our next swing point here. That's very important that we understand that we have to have body closures to establish our swing points. Okay. Now, I hope that makes sense, you guys. This is what it looks like on the live markets when you're actually looking from expectation to reality. All right, you guys, so let's shift over to premium and discounted pricing. And so I'm going to explain to you guys how this works. So on the left side, we have a bearish model that we're looking for sales, and we have a bullish model that we're looking for buys. So let's think about it as you're selling a product. Okay, whenever you sell something, you want to sell it at a premium price. You want to pretty much get the best price that you can for that particular product. Okay, and the same holds true when we're trading and we're looking for sales. So the idea is, because this is a bearish model, this is our swing high, this is our swing low. So we're looking for price to pretty much pull into premium pricing. Okay, because we're looking to sell. And so premium pricing, when you're utilizing your Fibonacci tool, and I'll show you guys these settings, we want to take sales or look for sales when price gets 50% or greater. This is our golden zone pretty much. When price gets up to premium pricing, this is where we want to look for sales, because it allows us to have a better risk to reward. Whenever we're looking for sales and we're in a downward trend, let's just say if we were to take a trade, somewhere up in this area here, our stop loss is above this protected high. This gives us a better risk to reward. So this is considered as premium pricing when we're looking for sales. We take a sale up here and we want to ride price down to this area here, or down to the -27 extension. Okay. All right. Now, when we're looking for discount, when we're looking for buys, okay, we can go back to the same analogy with when you buy something, you want to buy it at a discount. Okay, we don't want to buy it as a premium. We want to sell things at premium. However, we want to buy at a discount. So when price pulls back into discounted pricing, 50% or greater, that's where we want to look for our buys. So essentially, if we were to take a trade here, stop loss under here, ride price up to the swing here or the negative 27 extension. We want to buy low and sell high, that same notion. So this pretty much relates to supply and demand. You know, when you're in supply, we want to look for premium pricing to actually sell. When we're in demand, you know, we want to look for a discount so we can buy that product, or we want to buy price up. Okay, so now if we're looking at our Fibonacci settings, here are the settings that we have. You guys can screenshot it, you can copy it down, but I'm gonna move this over so you can see the values that I have. And then also, if you come down here, I have my background kind of shaded out. I have prices and levels checked, and I have percents. I like my labels to be on the right and on the top, and my font is around 12. Okay, so like I said, these are the levels that I have on my Fibonacci. If you want to learn more about Fibonacci, there'll be a link that pops up right here. You can learn more about Fibonacci. Okay, now if we're applying premium and discounted pricing to the actual market, it'll allow you to visually see how price can react and retrace to those particular levels. So as you can see, we have our swing highs and swing lows. And if we use our Fibonacci tool, okay, we'll take it from this swing up to this swing here. And we can see how price retraced within our discounted pricing because we're looking for buys, okay? So in this particular instance, price retraced here, came up, gave us a complex pullback here, and then it decided to race up to our negative 27 extension. So that's usually a TP, a first TP1, so to speak, whenever you're utilizing Fibonacci tools, okay? So we can remove that. Let's look at the next swing. We come from this point here all the way up to this point here. And as we can see, price pulled back, but price decided to break structure in this area right here. Okay, so now we can remove this and we can say, all right, now we have this is the 15-minute, now we have a break of structure. So now let's look at our structure. Okay, so now that we broke through this area here, we can see our two valid swing points, and this is actually where current pricing is right now. So we can take it from our swing high to our swing low, and we can see price is currently retracing into our golden, into our premium pricing right now to possibly give us some sales. Okay, and so if we look at this, this is our swing high here, our swing low, and then we have our trading range in this area here. So anything inside of here is considered as internal structure until we get a break from this area here, or if price decides to break structure. Okay. All right, you guys, so let's talk about fractal market structure. And so the best way I can describe what fractal is or what it means is, let's say if you have a triangle prism, and let's just say that you're zooming in on this particular triangle, but within this prism, you have smaller triangles that make up the big picture. So in essence, that's almost like the Forex market, where you have different time frames. Okay, and with these different time frames, you can break down a bigger structure, and you can break it down into micro structures as you go lower in the time frames. Okay, so for example, we have a 15-minute structure, which is indicated in black, and a 1-minute structure. So as you can see, your external structure is your big picture. These are your big swings, swing highs and swing lows. But inside of that, you have a 1-minute structure that has, you know, a micro structure in itself. So as you can see, when we're in this swing here, this swing high and this swing low, you can see that we're in a downtrend. You can see that here we have peaks and valleys that gives us a downtrend. And then in this area here, we have a break of structure. Okay. We have a break of structure. Let's zoom in a little bit. we have a break of structure, and we can see that the characteristics of this downtrend has changed to bullish. Okay, and so now we have another break of structure here, and price decided to change characteristics again. So inside of our external or our macro structure, we have smaller structures, which can be broken down into fractals. Okay, and so this is how we can catch sniper entries when price pulls back to premium and discounted pricing. Because what we can do essentially is, let's just say if we're trying to play the swing pullbacks on this, let's just say we're utilizing this high and this particular low. And as we can see, a lot of times we don't know when price is going to turn around and things like that. However, if we break it down on a smaller time frame, we can say, okay, in this area, we got a break of structure, and the anticipation is for price to pull back. So when it pulls back to some supply or demand zone, from there we can take an entry. Our risk to reward is really low, and then from there what we can do is ride price all the way down to the swing low. Okay, so that's essentially how we look at the market and how we can utilize a fractal market to help us with our risk to reward. Now, you guys, let's put it all together. How we can look at market structure, utilize our box method, premium and discounted pricing, understand fractal markets, and how we can put it all together to make one big entry strategy. Okay, so we're currently here on gold, and we can see that we have a low, we have a high, higher low, higher high, and another potential higher low. It's not confirmed because we didn't necessarily take out this high here. Okay, so since we understand and know our current low and high, our current trading range or our swing, we can actually take our box and we can mark up the high and the low. Okay, so we understand that everything within this area here is considered as internal structure, noise, and all of that kind of thing. Okay, so now we can say, let's look at premium and discounted pricing. Utilize our fibs, take it from the swing low to the swing high, and we can see that price already came down to our discounted area. So now we possibly already missed a move. We can see that price is possibly going to take out this high here, possibly come back down and continue in its intended direction because we're bullish. Okay, so let's go ahead and see exactly what price is going to do. So one of the things that we can see is price decided to go lower. And so being that it went lower, a couple things can happen. Price can possibly break this swing low, changing the characteristics of our 15-minute time frame, and we're possibly going bearish. Okay, and because of that, it'll change our entire bias. However, because we're still considered to be inside of internal structure, price can still turn around. So now this is where we want to break it down to the 1 minute time frame to kind of look and see on a fractal perspective if we can get a break of structure to maybe continue in its intended direction. Because like I said, if we're still in our box, we're still excuse me, we're still going bullish because we haven't broken outside the box yet. So one of the things though, let's go back to our 15-minute time frame. I'm curious about this area here and see exactly what happened. So let's go to the 1 minute time frame. So in this area, we can see we didn't necessarily have a break of structure on the 1 minute time frame because we had a high, we had a low. This would have been a potential high. However, I can see that price never broke this low in this area here. So this here is possibly a lower high. We can remove this one here, and price is possibly doing something such as this, maybe coming down. We don't know yet. All right, but we can see price is at a low in this area here. Okay, so now let's look at price over in this area. Okay, so one of the things that we can see is price came down, gave us a low, lower high, lower low. Okay, so now this is our swing high on our 1 minute time frame. Okay, so now we want to see if price will break this area, give us a break of structure, or if price will come up and continue to the downside to give us a break of structure on the 15-minute time frame. We don't know. Okay, so let's see. Okay, so we can see that price decided to break structure. So one of the things that we can do is we can say, okay, let's utilize premium and discounted pricing again. We can take it from the swing low to the swing high. And we can say, okay, we can see we have a demand zone right by our 61.8. We can utilize this area here as our entry model. Okay, and say we'll take an entry here, put our stop loss under the protected lows of the 1 minute, and we usually go for 1 to 3s. Okay. That's a 1 to 3 in that area right there. And we can say this here would be our TP1. Now our ultimate take profit, because we're targeting the 15-minute high. Okay. So our ultimate take profit is this area right here. All right, let's go ahead and remove our Fibonacci. And let's go back to the 1 minute time frame to see exactly what price is going to do. Okay. We can see price pinged us in, and price decided to go bullish. Price came down a little lower. It almost pinged us out. So let's go ahead and speed this up. Okay, we can see price took out our 3% area. From there, we could have took partial profits, and price looked like it's off to the races. And there we go. 1 to 13 risk to reward. And as you can see, this is what we can do to utilize market structure, utilize all the tools that we've learned, box method, premium and discounted pricing, fractal markets, to get sniper entries, and 90% of the time or 80% of the time stay on the right side of the trend. Hey, you guys, I hope this was informative for you, and I'd like to thank you for watching.
We strategize, then we capitalize on what we see. Wanna go to Pitville? Come join the Pip Academy and learn the Pip drill. Let's take the trip to Pitville.